Welcome back. We're at Precious Metal Summit, and I'm with Fred Bell, the CEO of Elemental Altus Royalties. Fred, good to see you.
Thank you for having me, Peter.
Good to have you on. We haven't actually had an update since last year, and that was just after the completion of the merger between obviously Altus Royalties or Altus Strategies and Elemental Royalties. What's happened since then? And I guess before we even go into all of it, just a quick overview as to who you are.
So, Elemental Altus Royalties, we're approximately 170 million US market cap royalty and streaming company. I think our key differentiator for investors is that of our roughly 70 plus assets, 10 are in production. Yep. So we have a really solid revenue base. We guided this year, I think sort of 17 million midpoint, and at the half year, we're exactly half of that, 8.5 million. So we're sort of on target for that range, and that is a real material difference with most of the junior peers, is how advanced some of our assets are and the fact that they're in production. And we've been growing pretty fast over the last year in terms of acquisitions and transactions, and again, I think that's something that as a company our size, you can scale up faster.
Yeah, agreed. And also it's an interesting one as well, because from a peer comparison, your revenue generation is actually top class. So before we go into the economics of the overall company, obviously since we've had the chat last year or you had an interview with yourself and Steve and Rod, I guess this merger, what's happened since then? What have been the benefits? What have been the news flow since last year?
It's a really good question, and I think the key thesis for us with the merger was that there was an awful lot of synergy by putting the two companies together. And one of the first things that we did, and it was in December 2022, was we announced a credit facility with National Bank and CIBC. So we are the only sub-$1 billion royalty company to have credit facilities with the major banks. And that took our borrowing cost from 10% plus SOFR down to 3.25% plus SOFR. So material reduction in our borrowing cost, and a true revolving credit facility, which we can grow with the company as we expand, and we do have additional ability to draw down on that now. And at the same time as refinancing that credit facility to a much lower cost, we also repaid some of that. So we took the overall debt down from $55 million US dollars to $30 million US dollars. Good. And so as of today, we have approximately 10 million in cash, $30 million drawn on a credit facility. We're cash flow positive. With the merger, we added more producing assets to the portfolio. So this year should be our 6th consecutive record year of revenue. And we're looking forward to next year, which should be another year of growth. And when you have that increasing revenue and you have that decreasing cost base, that's when you see margin expansion. And some of the deals that we've announced since the merger, and I think we've now announced 8 transactions in all, and that's 5 royalty acquisitions and 3 sales of some of the wholly owned projects that we had. And the combination of all of those is we're building out the portfolio. We're building it out in terms of revenue assets. So we're adding to our revenue base. We've added just recently, very recently, a development asset, which is a really good quality asset to go into our development pipeline, and some exploration assets. And at the same time as we've done that, we have partnered and sold our 3 projects that we had in Mali, Egypt, and Ethiopia. And through that, we have outsourced the ongoing investment in them, which is really critical, because I think we were spending 2.5 million a year annualized on those projects, and to be able to pass them on to really good quality partners. And in Mali, we have Allied Gold, in Egypt, we have Into Metals, and in Ethiopia, we have ANS. So we're passing them on to really good counterparties who can put more money into them, take them through the next stage. We still keep optionality exposure. I think from the Mali sale alone, we should see approximately $15 million in additional revenue to the end of 2025. And so we're reducing our G&A. We're outsourcing ongoing investment in some of these projects. And at the same time, I think our revenue base and our margins should be growing.
What's interesting, isn't it? Because since the merger, like you were sort of saying, you've reduced your debt. The amount of interest that you're paying has reduced. You've also reduced your margins on some of the exploration that you were doing, and you're actually monetizing not only the Elemental Royalties business that you already had with the royalty producing assets and doing more of that, you're also then monetizing the Altus Strategies model with the project generation and spinning those out. So it's been quite an interesting year for you guys.
It's been a lot of change and a lot of movement, but I think the realizing the latent value in the project generation side, I think we probably didn't get much value for those assets before. And so being able to put them in the hands of really credible counterparties.
Well, no, you can monetize it. You can actually show the value for them as well, right?
Yeah. And I think in this market, and it's across the board, it's been a very tough market. In this market, to be able to demonstrate that you are reducing the ongoing costs, and you're getting paid for it, you're getting returns in, you're getting ongoing exposure. I think it fits really well in where we are today.
Talk us through your current royalty. You've got 10 core royalties at the moment, producing royalties at the moment. Just talk us through some of the cornerstones, as you might call it. What sort of room for growth is there within the current portfolio?
Yeah, so I think in terms of the two probably most material assets in size and in revenue contribution are Carla Winder in Australia and Caserones in Chile. Mm-hmm. And Carla Winder is operated by Capricorn. It's a very well regarded Australian management team who previously built Regis Resources very successfully into a mid-tier miner, and they've taken on Capricorn, and they've done a really fantastic job with that. And that's a cornerstone. It's been a very reliable asset, and it should have a very long life ahead of it. The second royalty that again is really material for us is Caserones in Chile, and that actually did have some corporate action in the first half of this year, and Lundin Mining announced that they were acquiring majority stake in the mine, and that closed. And that's actually, I think, probably a real upgrade to have for us as a royalty holder, to have a public company operating it who will report publicly. Yep. So we can talk about the exploration and we can talk about the upside potential there in a way that perhaps we weren't able to when it was privately owned by JX Nippon.
Well, it's good as well, because obviously you'd assume that Lundin have taken that over because there is upside exploration there, or they believe it, there it is there, right?
Absolutely, and it's directly adjacent to NGX, not Lundin, very big shareholders in, and they also have, I think, for their Candelaria mine in Chile, they also have a desalination plant that in the future has the potential to unlock some of the constraints of operating where they are in terms of water. So I think there's a lot of excitement on the exploration front there. I think probably in the medium to longer term looking forwards, I think Lundin Mining almost uniquely placed to unlock some of the synergies they have across their portfolio to help. So those are two really core long life assets that we have that are already in production. And I think those underpin us, and in terms of growth going forwards, probably point to Allied's Bonacro mine. That is an operating mine, and it has been, but our royalty area should really kick in from Q4 this year.
Good.
And so going forwards, it should be adding sort of 3 to 4 million a year in terms of revenue. So it starts to become pretty material for us, contributor from 2024 onwards. And then maybe one other asset, which is also with Allied, that becomes more material for us on the revenue front from next year is Diebel Kampfler, which was a wholly owned project we sold, and we have an initial 3% royalty on that, and Allied have guided to getting that into production in H1 2024. Yeah. And so that should be again quite a material contributor for us going forward. So not only record revenue this year as it stands, but organic growth in the portfolio to make 2024 another record year of revenue. And if we can do that at the same time as reducing our cost burn and G&A, and realising value for some of the assets in the portfolio that probably were hidden, I think that puts us in a really good place. Yep. in the current market environment.
I wouldn't mind just touching on business development and the way that you're looking at the future of this business, because obviously, like you say, you've got two companies that have come together here, Altus Royalties, that was more project generator, very successful at staking land, exploring, finding partners, obtaining royalties. And then you had Elemental, which was, I guess, more inclined to have the existing producing assets or producing royalties that could generate returns. Is it still that dual focus? Is this new company still a dual focus company that is still going to be looking to stake land, still look to explore? Or is it now, you're at a size now where really the fruit is within sort of more producing assets within the royalty space? And what's the strategy moving forward?
It's a really good question. I think Altus had some really good quality producing royalties in their portfolio that they had acquired actually not too long before the merger. Yeah. But in terms of the royalty generation side, I think our number one priority was realising and unearthing some of that latent value in the portfolio. Yeah. So Altus had probably been the preeminent royalty generator in Africa, and for us to be able to demonstrate the value that they'd created across those assets. So I think really our focus at the beginning was getting the deals done in Mali, in Egypt, in Ethiopia, yep. and realising value, and we've closed Egypt. And I think hopefully shortly to close Mali and Ethiopia. So our focus in the very immediate term is that, and handing over. and a lot of the team on the ground and in country have gone with those new operators.
Good.
Which have meant that we're sort of in that handover phase now. So looking ahead beyond that, I think the immediate gain is we can show investors that we have realised value from those assets, and at the same time we've outsourced ongoing investment. And looking ahead, I think, look, we'll keep our eyes and ears open, but we won't have any immediate royalty generation side. We don't have projects in the portfolio, so we will be saving on the G&A on that basis going forwards.
Okay, and just lastly, I wouldn't mind just looking over sort of the economics of the company in general. You were talking about reduced costs and obviously higher revenues. Maybe you just give us a bit more information on what revenues could be looking like, stepping out consensus pricing if you need to, and sort of what sort of costs are looking like.
So look, we haven't really guided out beyond 2023. I think broadly speaking, where we are today, I think we could be talking about order of magnitude of sort of $5 million sort of revenue growth going
next year,
2024, and we'll get official operator guidance in the first quarter of next year probably. Okay. So we'll be able to narrow that down.
Comfortably above 20 million in revenue next year.
Yeah, I think we should. And look, if we can do that, what it does is it enables us to have free cash flow which we can actually deploy in this market.
Yeah.
And I mean, in this market, I think cash is really king.
Absolutely.
And there's a lot of good opportunities that are trading at 20%, 40% below where they were even 9 months ago. And so we are seeing a lot of deal flow on the royalty and streaming side, and I think that's reflected in the number of transactions we've done. And we have done more transactions so far this year than we have done in the last 2.5 years. Yeah. And we're going to continue to be really active. And for that, having cash flow is key. And I think when we set this company up, the real backbone of it and the thesis was producing assets that give you some measure of independence and security from the market. And we know mining's a volatile industry. We know it's a cyclical industry. We know it'll be ups and downs. And in the downturns, everyone can see the value, but often people don't have the funds and cash available to invest. And so if we can be to that extent counter-cyclical and we can actually redeploy some of our royalty revenue into new opportunities, I think there are some great assets out there and there are some great opportunities for us to keep growing the portfolio. And some of the transactions we've done so far this year, I think Arizona and Sonoran is a really high quality asset. We increased our royalty on the producing Caserones mine twice. We bought 2 royalties on the Pickle Crow mine. It's one of the highest grade former gold mines in Canada, with a really well-known management team. So in all those cases, we're really building out not just cash flow now, but also development pipeline. And we're doing it in a market where we probably couldn't have done it 2 years ago.
Well, it's a unique opportunity for you guys, especially now you've got cash flow, because $900 gold is still a very good price, yet the equity side of this market in the gold space isn't as favourable. So if you have got cash and you're ready to deploy and you've got the BD team already there, it's
and I think one of the interesting aspects is actually a lot of the opportunities we're looking at now, we probably did work on in some cases 2-3 years ago.
Yeah.
And maybe the stars didn't align then. Maybe it didn't fit our portfolio as well. So that really helps as well. That sort of intellectual property of having done this for now 5-6 years, and having built up a number of assets that we're familiar with, that we've looked at, we've done work on. It means that when the opportunity comes, sometimes we can move faster than we would have been able to do otherwise. And the nice thing about the merger as well that I suppose we haven't talked about is really putting the team together and giving us a better in-house team than either company had before. Yeah. And we have more bandwidth, we have more ability to do more transactions. There is certainly no way either of us could have done this many deals by ourselves prior to this. Yeah. So it's really nice now being able to have 1 or 2 deals going in parallel. And we've had at times, I think, 3 or 4 running in parallel. So we've been able to do that, and I think that helps keep the pace up of acquisitions and opportunities.
Perfect. Really exciting, Fred. Thank you.
Much appreciate it. Thank you, Peter.
Cheers.